Very good evening. Welcome back to my channel World Through Vera. Today's topic for discussion mutual funds. Mutual funds company pools money from many investors and invest that money into securities of stocks, bonds by debt funds for long term and short term. In that, some of the mutual funds are open ended, some of them are closed ended with timelines set with number of shares limited, fixed or open ended, allow continuous investment and redemption. The investors can choose to invest minimum 100 rupees to 5000 rupees in a SIP or more than that any amount. Systematic investment plan. SIP means systematic investment plan, normally on monthly basis, regularly. Second option in the mutual funds will be lump sum. One time single payment. SIP is always better. Continuously you can invest and over a period of 3 to 5 or 10 years at the annual CAGR of 8 to 15% or more than that we can able to get, depends on the fund we choose. Debt or bond funds gives normally 8 to 9%. Equity stock funds gives 12 to 15% or more. For the SIP you can add lump sum whenever you get bonus or some other revenue or revenue from agriculture inheritance. Mutual funds always allotted as a units based on NAV. NAV is net asset value. Market index points up and down movement will affect NAV. Based on this, on up movement we get less units, and when market crashes we get more units, and existing units value may go up or come down, but the units already purchased will be same. Keep increasing 5 to 10% of investment value every year. Keep this auto execution options while opting for SIP. Mutual fund investments you should do normally on goal based, like goals of higher education, your own marriage, house purchase, or one more important aspect of mutual funds, you should always plan your retirement in head. This retirement account should be always a continuous one. You should start all these baskets of investment from the day of started money. In that, mutual fund equity funds is one critical investment to meet and inflation. Mutual equity funds are very critical for a retirement as well as beating the inflation. Before any goals, timelines are reaching 2 years to 6 months in advance, to take out your requirement and put it in a fixed deposit. Rest don't take out, let it grow. Anytime you want some money for your needs or emergency arises, you can sell exactly that many units to get the money what is required. Take that much money only, rest will keep as it is for growing your investment into abundant wealth. Any investment will have some risk associated with it. Mutual funds have market risk, interest risk, management risk, inflation risk, liquidity value risk, credit risk. Investors can try to minimize risk by diversifying across sectors and asset type, taking mutual funds, advisor support, strategically switching investments from non-performing to performing commodities. Better option, if you don't need a regular money, go ahead with regular growth option. In this, the dividend given also reinvested for growth. Market linked mutual funds are having little higher risk and as well higher reward ratio compared to low risk and low returns of debt by bond funds. Mutual funds, investment considered as a tax deferred. The capital appreciation or gains once redeemed. You sell them. Unit sold, then only you have to pay income tax. Short term case units, when you sell within 1 year, those units, short term capital gain of 20% will be attracts to pay it, and long term capital gains which are sold beyond 1 year up to 1.5 lakhs of gain is exempted. Over and above this, you need to pay 12.5% as a long term capital gains. Main benefits with mutual funds: you can start with a minimum amount starting from 100 rupees, not required any heavy capital. Say with rupees 100, no upper cap limit. Professionally managed funds and management, high liquidity, low cost, high returns, affordability, safety, and transparency. Now the price, you know the price every day, anytime you can sell or anytime you can buy mutual funds. SIP allows you asset to grow, then your wealth to give. Mutual funds always try to keep it for a long time of 15-20 years. Whenever you are investing in mutual funds, as I told in the beginning, try to keep 5 to 10% increase every year. Ensure good mutual funds you are choosing. In case non-performing mutual funds, try to switch over to the performing mutual funds. Ensure always you get a 15% returns. In that case, if you are investing in mutual funds 10,000 rupees in a month, at the rate of 15% for 20 years, you are going to get approximately 1.5 crores in the return as accumulated wealth. So better always see the fund managers who is always managing the funds in a better way, and they are into market for at least 5 to 10 years. See their expenses ratio also. All these factors you consider it before investing it, and keep investing and continue investing only when you require. Then only you try to withdraw that much units. Normally people say you take systematic withdrawal plan after you accumulate wealth in mutual funds. This is also not advisable for everybody. This is advisable only for them who require a monthly revenue for their expenses and they are going to depend on only this mutual funds corpus. Then they can take it. Rest of the people, please don't take out in a systematic withdrawal plan. In case you don't have any other revenue, then only you take it. You have an other revenue, first try to consume that money which is a taxable bracket, like your annuity, your pension, and your fixed deposits returns as an interest. These are all income to added to your taxable, and it attracts income tax. Mutual funds, or you invest in equities, it is not going to attract any income tax until unless you are going to sell those equities or mutual funds. Then only you will attract a short term, long term capital gains, as we already discussed. Keeping all this in mind, go ahead and invest in a mutual funds according to the market conditions. As I already told, risk parameters, what is associated with the mutual funds. Mutual funds having a market risk when you are investing in an equities funds. In that cases, you may lose your principal some extent, depends on the bear market, when market enters into negative, giving a negative returns. It may be a 40%, 50%. In any major pandemic cases, up to 60% you may lose. But eventually, market will come up within a year or two, maximum in a 1.5 year to 2 years. Then again, mutual funds going to perform. And what I suggest, mutual funds, whoever don't want to take a risk, they want to mitigate risk, they can go ahead and invest in index funds. Index funds clearly invested based on the index. Normally example is BSE 500 or Nifty 50. Those are shares which is under the Nifty 50. On that shares, index mutual funds, they invest it. Those investments automatically will grow along with the index. If you take an example of market, while in Corona, it's almost touched 28,000. Within 8 months to 1 year, it has reached 40 plus thousand again. From 2021 to 2024, market reached 82,000, almost a double, in the sense 1x returns over a period of 4 years. Index funds always try to give a returns linked to the market, and index funds you can expect 15% to 18%. Average returns will be 16%. But index funds will progress very slowly along with the index. So you will not able to see any immediate returns on an index funds like other mutual funds in equities where they are invested. Sometimes CAGR, it may be more than 20%. If we see last 2-3 years from 2022 to 2024, average returns for the 3 years, it's a more than 60%. And if you see CAGR, it's almost 25 to 30%. But small cap funds always not advisable. A very limited amount you can invest in a small caps. Major amount you should invest in index funds or large cap or multi cap or hybrid. This is about the mutual funds. Thank you. Signing off. Good night. Valtruvira.